Hi, it's Professor Mike, and we're on to Chapter 17, Audit Sampling for Tests of Details of Balances. So this is roughly similar to tests of controls and a test of transactions. You're trying to make an assumption or an inference about the entire population based on a sample. So these are the same things. You're going to use the same steps to calculate sample sizes and to make assessments. Um, and you are going to be subject to both sampling risk and non-sampling risk. The difference is when you're testing controls, you're testing the operating effectiveness of the controls. When you're testing transactions, you're testing internal controls over those transactions, but you're also testing the monetary amount of the transactions. The test of balances are actual account balances as of the date that you're testing to see if they're materially misstated or not. So there's a slightly different objective, definitely different objective than based on tested controls, and slightly different than based on tested transactions. So your balances are what you're opining on from a balance sheet perspective, and this is where you're going to spend a fair bit of time from a substantive transaction basis, and that's going to affect your sample size. Um, you know the the test of controls and the test of transactions reduce your sample sizes for your substantive tests. Okay, so once you've determined that those are at an acceptable risk level, then you can reduce your substantive testing sample sizes. Um, we went through non-statistical and statistical sampling. We went through the 14 steps. The 14 steps are the same whether in the non-statistical or statistical, except that the methodology for choosing sample items in non-statistical sample is broader. You're more restricted in your statistical sampling, but you're going to have larger sample sizes in non-statistical sample because you can't have the same reliability on the conclusion. So I won't take you through these steps again. You can review them. You should know them for the CPA exam. Less important to know them for the quiz, but there are emphasis points between the difference in non-statistical versus statistical sampling, how you pick things, and how you evaluate errors. Um, so the all this ties back to the audit risk model again, right? If control risk is not effective, then you're going to do more substantive procedures. And you can see at the very bottom of the diagram, extensive substantive testing is required if control risk is 1 or 100%. Um, so if the, the controls are considered effective, you've reduced your control risk, which means that when you're solving for 0.05, you can increase your detection risk, which means that you are not going to be doing as many substantive procedures. Um, so that only applies if you've done appropriate testing of your controls. Okay. Um, and here's other relationship illustrations between the various parts of the audit risk model. So you can see the effect on sample sizes, increase and decrease, the effect on your conclusions, and so everything comes back to an audit risk model. Um, what you're going to do in calculating your sample size is really figure out what your acceptable risk level is, what your other audit procedures are, how much evidence they give you, how much control risk is helping you reduce your substantive procedures, and then you're going to calculate your sample size. These are the mechanics of calculating the sample size. Again, you're not going to be quizzed on this. This is based on the AICPA audit sampling formula. So um, this is not a this is something that will give you reliable information and you are able to lean on this as these are the auditing standards, and somebody who's suing you, or if the auditing standards, it's a much tougher thing to challenge you on unless you haven't, unless you weren't really exceptions, etc. That's your non-sampling risk. But from a sampling risk perspective, if you're following the AICPA guidelines and their calculations of sample sizes, you're well protected. You have complied with the audit standards, and therefore you could not be accused of gross negligence if you properly applied those audit standards. So monetary unit sampling basically uses a dollar as your unit. That's why it's called monetary. So the dollar is the amount, is the unit, and then you'll select items based on that dollar, and that dollar could appear multiple times within the same invoice. So, for example, let's say you've got a $10 million population and you've got one item that's $2 million and your monetary unit is $50,000. Well, you're going to hit that $50,000 monetary unit 40 times, or maybe 39 times within that one invoice. But you only have to audit that invoice once. But the monetary unit sample gives you credit for having audited 40 items. So it's actually very, very efficient. It is appropriate from an audit evidence standpoint. And I know it might give you pause to say, oh, I should pick more items. But when you think about it, if you're covering 20% of the population with one invoice, that gives you a heck of a lot of evidence. And so that's why this is used quite often in audits. So the deciding where to use it, will be the same kinds of analysis you would do in any other sampling. So what you really want to focus on is the fact that you're going to get coverage from high dollar items. It's going to reduce your cost, and it's better and more defensible conclusion. So definitely this is a preferred methodology. But if you get misstatements, they may be found too high, right? So if one transaction blows up, it probably blows up the whole sample. And if nowadays you probably are using computer selections to do these things, so it's less of an issue. But if you're doing this manually, you probably don't want to use monetary unit sampling. So where you're going to use it is you don't expect a lot of errors. You want to get a dollar result, which is a balance. And you want to be able to basically do this electronically. Here's an example of calculation in monetary unit sampling. I'm not going to go through it. Variable sampling, it's really about sampling distribution and looking at different elements of the transactions. And this is used to state conclusions from a confidence interval because we don't know the population size. So we'll look at a difference estimation or ratio estimation or mean per unit estimation. These are all defined in your text. But basically, these allow us to make inferences about the population on a statistical basis because we've done variable sampling. So stratification is a way to separate the population into different groups, like high dollar items, low dollar items, and to put a portion of your emphasis on higher dollar items. Like you may do 2/3 in a non-statistical sample with higher dollar items, 1/3 on lower dollar items. And there's a bunch of different calculations and acceptable risk formulas that you would do for variable sampling. So you can use difference estimation. This is an example. You say the tolerable misstatement is 21,000. Your risk of incorrect acceptance, in other words, you accept a conclusion that's incorrect, is 10%. And then incorrect rejection is 25. So you'll calculate your sample size and you'll actually estimate from that sample the variance in the population and generalize it to the entire population. Again, many ways that you can do calculations. One thing I want to emphasize in especially confirmations is that selecting your sampling unit is extremely important. Normally, an AP clerk can look up an invoice number and be able to confirm whether an invoice is paid or not. It makes it much harder for them to confirm a statement balance. So you may, as an auditor, say, oh, at December 31st, I want to send out statement confirmations to all of the customers in the sample because that's going to give me the most coverage and the most information from my audit perspective. But it may also give you the most errors. Why? Because if a AP clerk shows that they did a big check run or a big wire run on December 31st and paid off a bunch of your invoices, then those invoices are not going to be showing as outstanding on their accounts payable subledger on December 31st. But you won't have received the cash or applied the cash to those invoices on December 31st. So you're going to send a statement with a bunch of invoices on it that the customer's AP clerk is going to say, we've paid those invoices. And then you're going to have to go ahead and do alternative procedures. The better approach is to send invoice confirmations, and then if they in fact can have paid the invoices or an invoice in the same way that I described earlier, in other words 1231, you're not chasing down every invoice on the statement, because your unit of measure on a statement balance is that the dollar amount of the statement equals what is owed. And when you get exceptions, because things are crossing in the mail or in the wires, that undermines your statement balance objective. If the invoice is your unit of measure, your unit of sampling, and it was paid by the customer on the 31st, but you had not received and applied the money on the 31st, then that's an easy exception to clear, right? Because the invoice was properly paid, it was outstanding from your perspective, but you're only chasing down one item, and your unit of measure is still appropriate. So defining your unit of measure, your sampling item, and your definition of what an error is in both monetary and attribute sampling, like control tests, is extremely important because that will talk about how you document your exceptions and then accept or reject conclusions based on your sampling methodology.